Welcome to the Deep Dive. We cut through the noise to get you the insights you really need. Today, we're diving into something many dream about: buying property in Thailand. You know, that amazing villa, maybe a beachfront condo. It sounds incredible, right? But anyone who's looked into it knows it can get complicated fast, especially when you hit the topic of property taxes for foreign buyers. So to help us navigate this, we're focusing our deep dive on a really insightful article. It's called Foreign Buyer Taxes in Thailand, Fact versus Fiction, and it's from Ocean Worldwide. They're a luxury real estate agency, actually based right in Phuket since way back in 2004. Their director, Sandra O'Neill, she's helped literal thousands of families, investors over the years. It's worth noting, too, Ocean Worldwide really hones in on that luxury residential market, specifically in Phuket and Koh Samui. So they know this stuff inside out.
Absolutely. And our mission today really is to cut through all that confusion. We want to lay out the actual facts, so you can make smart choices without any, nasty surprises later. What's quite fascinating about this source is just how clearly it breaks down what often feels like a total maze. Think of this as your shortcut to getting properly informed.
Exactly. We promise a clear breakdown. We'll unpack the numbers, look at different scenarios. Okay, let's get started and really dig into what you need to know. Right, first things first, the big picture. When you see that price tag on a property in Thailand, that's not the whole story. It's a bit like buying a car, There's a main price, but then there are always those extra costs. For property here, you should probably budget for, say, an extra 5 to 7% of the sale price just for taxes and fees.
That's a really good point. It's not just one tax. It's a bunch of different taxes and fees that definitely add up. You've got the registration fee, specific business tax, SBT's stamp duty, and withholding tax. And understanding cadastral value is key here. Basically, it's the government's official valuation of the property. It's often lower than the market price. And crucially, it's the base for calculating many of these taxes. And these apply whether the seller makes a profit or not, by the way. So knowing these upfront costs is just essential to make sure the investment, aligns with your goals.
Okay, let's break those down. First up, the registration fee.
Yeah.
People often call this the 2% transfer fee. It's pretty standard.
Yeah.
It's the charge for officially transferring the ownership over at the land department. The really important thing, as you said, is it's based on that cadastral value, not what you actually paid. So if the government value is, let's say, 5 million baht, the fee is 100,000 baht. Simple as that.
Right. And traditionally, that 2% is split.
Yeah.
Usually 50-50, buyer and seller each pay 1% of that cadastral value. But, and this is important, it's not totally fixed. It can be negotiated.
Oh.
Yeah, the final sales contract will spell out exactly who pays what percentage.
That raises a question, though. How much wiggle room is there, really? Can you often shift that 50-50 split significantly?
Well, it does depend. Market conditions play a big role.
Yeah.
How eager the buyer and seller are. In a hot market, maybe the seller won't budge much. But if it's slower, a buyer might be able to push for the seller to cover more, maybe even all of it. It all comes down to what's agreed in the contract. So clarifying that early is key.
Definitely. So if you were looking at, say, a lovely villa out in Bangkok in Phuket, getting that cost split clarified right at the start is super important. Avoids arguments later. Okay, so that's the initial registration. What about selling? That brings us to the specific business tax, or SBT, the quick sale tax, as some call it. This one can be quite hefty, especially if you haven't owned the property for long.
Yes, SBT generally kicks in under specific conditions. If a company is selling, they'll probably pay it. For individuals, it's mainly if you've owned the property for less than 5 years, unless it was your primary residence. There's an important exemption there. If it was genuinely your main home, registered in your name for at least a year from the purchase date, you can often avoid SBT.
Ah, that's interesting.
It is, isn't it? What's fascinating is how this exemption sort of encourages people to actually live in the properties, not just flip them quickly. It shapes the market.
Right. And the rate for SBT, it's 3.3%. That includes a little bit of municipal tax, too.
Yeah.
And critically, it's calculated on whichever amount is higher, the actual selling price, or that official cadastral value.
Yeah.
So, quick example. Sell for 10 million baht, cadastral's 8 million. You pay 3.3% on the 10 million, that's 330,000 baht. Quite a chunk.
It really is.
Especially if you were planning a fast turnaround, perhaps on a property like a villa over in Koh Samui. Something sellers need to factor in.
Absolutely. And it really highlights the complexity of the system. Getting professional advice is almost always worth it here. And just to add, if SBT doesn't apply, say you owned it longer than 5 years, you're likely looking at stamp duty instead.
Right. Stamp duty. Good transition. Think of this as the backup tax, maybe.
Yeah.
It only applies if SBT is off the table. So owned for 5+ years, or it was your main home as an individual. Then you're looking at stamp duty.
Exactly. And the rate is much lower, generally 0.5%. Again, it's calculated on the higher of the selling price or the cadastral value. Same principle as SBT. So sell for 10 million, cadastral 8 million. You pay 0.5% on the 10 million, sell for 9 million, but cadastral is 11 million. You pay on the 11 million.
Okay, got it.
Usually the seller pays this one, but like the transfer fee, it's negotiable. It should be clear in the contract.
And there's a less common detail about stamp duty too, isn't there?
Oh.
About leases.
Ah, yes. Good point. It also applies to lease transfers, but the rate is tiny, just 0.1%. That's calculated on the total rent payable over the whole lease period.
So if the total rent for the whole lease adds up to, say, 5 million baht,
then the stamp duty would just be 5,000 baht. And that small amount is typically shared between the person giving up the lease and the person taking it on.
Okay, moving along. Next up is withholding tax on property sales. This sounds like an upfront income tax payment.
That's essentially what it is. It's deducted at the time of sale. And how it works depends on who's selling. For a company, a legal entity, it's simple. A flat 1%, calculated on the higher of the sale price or cadastral value. Done.
Okay.
For individuals, though, it gets more involved. It's a progressive rate, meaning the rate increases with the income amount. But crucially, how much tax you pay is heavily influenced by how long you've owned the property. The system gives you deductions based on the years of ownership. For example, own it for just 1 year, you get a 92% deduction against the cadastral value before calculating the tax. Own it 8 years or more, that deduction drops to 50%.
Wait, the deduction drops the longer you own it. That sounds counterintuitive.
Yeah.
Usually longer ownership means lower tax.
Good catch. Apologies, I misspoke there. Let me clarify that deduction structure because it's key. The deduction increases with ownership duration, reducing the taxable amount. Let me rephrase. The calculation involves assessing the property value, applying a deduction based on years held. The longer you hold, the larger the deduction percentage, and then applying progressive income tax rates to the remaining amount. For example, holding for 1 year might give a small deduction, while holding for 8 years or more gives the maximum deduction, which I believe is actually 50% of the calculated gain, not 50% off the whole value. Let me double check the exact source phrasing. Ah, yes. The deductions effectively reduce the taxable portion of the gain, calculated based on the cadastral value and years held. A 1-year hold allows a 92% deduction from the assessable income, 2 years 84%, down to 50% for 8 years or more. The longer you hold, the less income is subject to tax. My apologies for the earlier confusion.
Okay, that makes more sense. So longer ownership does reduce the taxable amount significantly before the rates apply. Thanks for clarifying. How significantly does that ownership period impact the final tax bill then?
It can be very significant. That deduction directly lowers the base amount that the progressive tax rates, up to 35%, are applied to. Holding for 8+ years versus just 1 or 2 can mean a huge difference in the withholding tax paid. It really incentivizes long-term holding for individuals.
Right, and the seller's responsible for making sure this is paid correctly.
Yes, definitely the seller's obligation. Getting the calculation right is vital to avoid penalties. It can get complex with the deductions and progressive rates.
It sounds like it. I imagine using an online property tax calculator could be useful here, just to get an estimate.
For sure, they can give you a good idea.
Especially if you're, say, considering selling that villa in Phuket we mentioned. It's part of the essential homework. And obviously, getting professional legal or tax advice, maybe from specialists like Ocean Worldwide, is probably the safest bet.
Absolutely.
Okay, now for some genuinely good news, especially for long-term owners or investors. Let's talk about annual taxes. Generally speaking, and this is a big one, there's no annual income tax just for owning residential property in Thailand.
Yes. This is arguably one of the biggest draws for foreign investors compared to many other countries. No annual wealth tax, no significant yearly property tax bill just for holding your house or condo. It drastically lowers the ongoing cost of ownership. That's a huge benefit, a real game changer for long-term value.
There is one small exception, though, right? Something about undeveloped land.
That's correct. There's a minor annual land tax if you own land that isn't developed, basically no buildings on it. The rate is very low, usually around 0.1% of the assessed value. It's more about encouraging development than raising significant revenue.
But, and this is a really important, but if you rent out your property...
Then that rental income is taxable. Absolutely. You have to declare that income, and it's taxed at the standard progressive personal income tax rates, just like salary or other earnings. So keeping really good records is crucial. Track your income and also your allowable expenses like repairs, management fees, things like that. These can reduce your taxable income. If we connect this to the bigger picture, This is standard practice globally, right? Income from assets is usually taxed.
Makes sense. So, for instance, if someone bought that prime sea view land plot in Kamala, Phuket, that Ocean Worldwide might list, maybe it's priced around $99 million, bought if they plan to build and rent or just rent the land, they absolutely need to factor in tax on that rental income.
Precisely. It's key for accurate financial planning.
Okay, what about when you actually sell for a profit,
Yeah.
capital gains tax?
Well, Thailand doesn't have a separate capital gains tax system for property in the way some countries do. Instead, the profit you make from selling property, the capital gain, is just treated as regular income for that year.
So it gets added to your salary, rental income, whatever else, and then taxed at your normal progressive personal income tax rate, which goes up to 35%.
Exactly. It's rolled into your overall income assessment. Although, there's an interesting little perk for stock market investors. Gains from selling shares listed on the stock exchange of Thailand are usually exempt from this income tax.
Good to know. And briefly, what about inheritance tax and gift tax? Are they major concerns?
They exist, but the thresholds are quite high. Inheritance tax only kicks in on assets over 100 million baht received from one person. The rate is 5% if it's from direct family, 10% if from someone else, but only on the amount above 100 million.
And gifts.
Gift tax is generally 5%, but there's a generous exemption. Gifts between close family, parents, kids, spouses are exempt up to 20 million baht per person per year. Only amounts above that get taxed at 5%. And just circling back to capital gains from property for individuals, remember those deductions based on ownership duration we discussed for withholding tax? They also apply here when calculating the final income tax on the gain. So again, holding the property longer reduces the taxable profit.
Ah, so it helps with both the upfront withholding and the final income tax calculation.
Correct. It really emphasizes how long-term planning can pay off within the Thai tax system. If you were eyeing, say, a stunning 5-bedroom luxury villa in Phuket, understanding how these long-term holding benefits affect the overall tax picture is definitely wise.
Makes sense. Okay, finally, any specific points just for foreign buyers? And are there any other incentives we should know about?
Well, the main thing for foreign buyers isn't different taxes, but different ownership rules.
Right, foreigners can own condominiums outright in their own name.
Exactly. But for land, and therefore houses built on land, it's typically structured as a long-term leasehold, usually 30 years, often renewable.
That ownership structure difference is key.
It really is. And also, watch out for the 7% VAT. That can apply if a business sells a property within 5 years of acquiring it. More relevant for developers or quick flippers, maybe.
So navigating these ownership structures, the leases, this sounds like where professional advice is non-negotiable.
Absolutely critical. Especially legal advice from someone specializing in Thai property law. They can ensure the lease structure is sound, the paperwork is correct. It's an investment that prevents huge potential problems later. Agencies like Ocean Worldwide often work closely with such legal experts.
And incentives. Anything else boosting the market?
There are sometimes government stimulus measures aimed at Thai nationals, which can indirectly help the overall market sentiment. But the key incentives we've already touched on are pretty significant. That SBT waiver for inherited property is one, and the big one, really, is the lack of a substantial annual property tax on your main residence or second home.
That absence of annual tax does seem like a major draw.
It really is. What's fascinating is how these factors combine to make holding property here, maybe a luxury beachfront place in Phuket, quite attractive long-term compared to other locations. It's not just a small difference. It can really add up.
Okay, so let's wrap this up. After this deep dive, the main takeaway seems to be there isn't a special foreign buyer tax that singles you out in Thailand. But there are definitely significant taxes and fees involved for everyone when buying and selling. It's not free money.
Not at all.
Understanding those key ones, the transfer fee, SBT, stamp duty, withholding tax, and knowing that some parts, like who pays what, can be negotiated, that's crucial stuff.
Absolutely. Being prepared, getting accurate information, seeking that expert advice, that's how you navigate this successfully. As we often say, good information and professional guidance are your best assets, especially in a market that might be new to you.
So a final thought for you, our listener, to chew on. Given what we've unpacked about Thailand's property tax landscape, the lack of annual tax, the incentives for long holds, the structure, how does this reshape your view on investing here? What stands out to you as maybe the most surprising or perhaps the most beneficial aspect from our discussion today? We hope this deep dive has armed you with the clarity you need. Keep asking questions, keep digging deeper. Thanks for joining us.